All right. Perfect. Okay. I'll just put this over here. Okay. Hi, my name is Ross McElmurray. I'll be sharing my project for Management 490. This is the DCF valuation calculator or the tool. Oh, maybe you can't see my face now. Hold on just a second. Maybe. There we go. All right, perfect. Um, So yes, it's the DCF corporate valuation tool. Um, and it's a tool that's been designed to help investors answer the question of what is this company actually worth? Um, with all the constant changes companies are going to go through that affect market prices, um, this is going to be able to pull together everything very quickly. Um, discounted cash flows analysis will answer these questions, such as how will this business generate, or how much cash will this business generate, and what is the cash worth today? Building these typically will take many hours, and you have to gather a lot of different information from a lot of different places. Instead, this has it all instantly at the snap of your finger, at the press of a button. Um, it's very stress-free, it's very easy to use, and very easy to understand. Little side note, most of the information we're getting comes from Yahoo. And with that, we will go ahead and enter. So right here, you can see you can enter your ticker symbol. We're going to go ahead and just do Apple, auto-filled. And everyone's pretty aware of what Apple does and who they are. So this is a pretty easy one. So we're going to go ahead and press the Fetch Financial Data button. And boom, as you can see right here, you've got your company, you've got, some of the categories we all know it's technology, consumer electronics. Nice big and bold, you got the current market price right here. The red indicating that it is probably down. So you got it at 263.75 USD. Um, Over here, we're going to see a lot of our key financials. So, you've got your revenue, EBITDA, free cash flow, operating cash flow, total debt, net debt, et cetera, et cetera. Um, just to talk, and then, oh, sorry. And then over here, you have some of your metrics just to show how we're going to be calculating a lot of this, which is your beta right there, your market cap, your shares outstanding, your 3-year revenue under CAGR, um, your FCF, sorry, your FCF margin, and your tax rate, and then your auto whack. Um, all those values right here, so it's pretty easy just to see exactly how we're going to be calculating, and how we auto-filled these immediately under the company like Apple. And then right here, you can see your DCF valuations that you get. So, these are obviously what we're going to be looking at and the most important things. Starting with the enterprise value right here at 1.32 trillion, and that's going to be your total business value in short term, or not in short term, but in to paraphrase a little bit, this is just your business total business value right here. We have your net debt, which is going to be your debt minus the cash you have. So right here, you can see 23.6 billion is your net debt. You have your equity value, which is going to be the EV minus the net debt. So pretty simple right here. You have your intrinsic value divided by share, which is going to be your equity value divided by shares outstanding. Um, and we'll talk about this little number right here a little bit later. And then you have your margin of safety price, which is going to be your intrinsic value discounted by a safety buffer. With that safety buffer we have right here, it's going to be 20%, which can also be adjusted, but we're going to talk about that later. Um, right here with this little red upside down arrow, so this is typically going to indicate that the current stock is overvalued. If it were green and pointing up, it would be undervalued, but this is about how much it would be overvalued by, and you see 66.5%. And then once again here, you have your model settings, which are all going to be right here. We're going to talk about these a little more in just a second as well. But these are going to be what have been used to calculate these exact values that we have right here. Um, but yeah, to get into that a little bit, you scroll on this left side, we see a bunch of different little sliders right here, and these are going to be your model assumptions. Um, Starting with your weighted average cost of capital, which is your discount rate, um, the blended return required by equity and debt investors, and we calculate this on the app using CAPM. Um, so as you can see, all of that's right here. Um, then you have your near-term FCF growth percent. Um, just a second here. Oh, sorry. Talk a little bit more about WACC here. Um, we're going to calculate this using the current risk-free baseline from the 10-year U.S. Treasury yield, which is going to be 4.5%. We're going to calculate it from the beta, which we get for this stock specifically from Yahoo. And it's going to measure the stock's volatility relative to the market. We're also going to use the ERP, which is the long run equity risk premium. And that's going to be 5.5%. Um, and then we're also going to use a reasonable investment grade cost of debt, which will be reduced by a tax shield. And using those with an equation, we're going to calculate um, our weighted average cost of capital, which once again you can see right here with these little question marks on the side. When you hover over, it's going to provide a little explanation, but that's how we're going to get our WACC right there. And then talking about the near-term FCF growth percent, um, the app is seeding this from the company's 3-year revenue CAGR. This is the growth Apple has actually delivered to us, so we know this is true. Um, Usually it's going to be around 6.8%, which on here we have it at 1.1, but usually that's going to be a little bit higher. Maybe right now it's not, but that's a little, still we can change it right here. Um, and we're keeping this anchored to historical data rather than speculation, um, because we'd rather like keep that solid while we go check the sensitivity grid for the more optimistic or non-optimistic cases. Then we have our terminal value method, and I'm mostly going to be sticking to the Gordon growth model for this explanation just um, for the time. But the terminal value is going to capture everything after the projection horizon, and it typically represents 65 to 80% of the enterprise value. And so it's kind of the most important metric of all this, if you will. Um, so with the Gordon growth model, we're going to find terminal growth of 2.5% approximates long run GDP. And this is going to be the ceiling for any mature company in perpetuity, which is why we have it right here. Um, all right. So as you can see, with these little sliders, we're able to adjust just a little bit. Um, for example, if we go raise the WACC to about, 13%, something like that, intrinsic value is going to drop sharply because every future cash flow is discounted more. Obviously, with discount rate, you're going to take more of a discount. Um, and lowering, oh, sorry. And if we lower the WACC, you can see that the opposite happens and our value is going to go a little bit up. So let me put this back to 10.5. On the other hand, with the long-term FCF growth, um, you know, lowering this from maybe we say you have it at, 13%. This is going to increase things quite a bit. But if we pull it down, the FCF is going to shrink, pulling total value down with it. Um, so the way that the DCF math works in a little more complicated terms, just to give you a better explanation. The grow base FCF forward year by year at the growth rate. Sorry, this is a step-by-step situation, but one, we're going to grow base FCF forward year by year at a growth rate. Two, you're going to discount each year, so the present value equals the FCF year divided by 1 plus the weighted average cost of capital to the power of the year. Then you're going to sum all discounted FCFs. You're going to add a present value of terminal value, and then you're going to subtract net debt, divide by the shares, and then divide by the intrinsic value per share, or find the intrinsic value per share with that. That's going to be the more complicated methodology to how all of this calculates everything. But yeah, then finally we'll get down to Oh, one more thing here. This is going to be your projection with present values all available right here. As you can see, with each year, we can see what would be projected for the FCF, and we can see what the present value of the FCF is and how that would, look in the future years. We can also change the number of years. So now we can do something like 10, we can go down to 8, or sorry, it's going to work in intervals. My apologies. So we're going to do 5 or 10, but as you can see, it's all available right here. And when you hover over these numbers, you can get, you know, the exact amount if you're not trying to squint and look. You can also take a picture, download it as a PNG. Um, yeah, but moving to the final part of this is the sensitivity analysis, which might be the most important tool available to us right here. It's a 7 by 7 grid, which is going to be testing your weighted average cost of capital against terminal growth rate. We have our standard number, it's kind of right here, but you can see you have all these different scenarios of, if you're at 10.5% whack against a 2.5% terminal growth rate right here in the middle. Um, this is going to be what you're valued at. And for a more basic understanding, if you're not trying to get into the math of each thing, these green squares are going to represent values that where the intrinsic value is above the market price, meaning it's undervalued. Whereas these red squares are going to represent when the intrinsic value is below the market price, so it'll be overvalued. Um, the WACC and terminal value are the two assumptions that swing results the most. So small changes compound into large valuation differences. Near-term growth matters, but it's the terminal value that dominates. So what we're going to be looking for is if the majority of the grid is half, you have high conviction, and if the majority is um, red, it'd be the opposite. And, your job is to assess which region is the most realistic based on the dominance that we see here. You're also able to increase these amounts down here. And once again, when we change things like the weighted average cost of capital, we're going to see a little bit more green come in. Maybe a lot more green if we do that. Or if we change the terminal growth rate, maybe decrease that, a little more green, and once again, or increase it by a lot, maybe a little more red. I'll put this back down to 7 as well. But yeah, that's about it. Thank you for joining me. And yeah, bye-bye.